The Lodha Group is one of the largest developers in the Mumbai metropolitan region. In fact, the country. The real estate giant has 39 ongoing projects, including the Trump Tower in Mumbai and 2 in London. Not surprising then that the builder has, over the years, been able to raise funds with relative ease. Overall slowdown in the sales, however, has raised a few eyebrows over the company's ability to honor its repayment calendar as well. Rating agencies have recently downgraded the dollar-denominated bonds. Moody's says it's due to the continued uncertainty over ability to refinance upcoming debt maturities. So are these concerns warranted, not just on the company, but on the space at large? And if so, what's the way ahead? Let's ask the MD and CEO, Abhishek Lodha, who joins in our studios to talk about all that and more. Abhishek, so good having you. Thanks much for being with us today. Let's start off with the space. A lot of conversations around how, at least in the equity circles, about how the next 5 years will belong to the real estate space, because there is only as long a period for which a space can remain under a bit of cloud before it comes back. The whole conversation around how the contribution to the GDP is about 9%, but the presence is only 1%, and therefore the space at large will move up. Do you believe there is fundamental merit in trying to time the recovery in the real estate space?
I'm not an equity expert, and therefore
but the space at large.
So we are fundamental believers that in any economy in the world, if the economy does decently, real estate does decently, and particularly housing does decently. In India, over the last 4 or 5 years, housing, because of oversupply in certain parts of the market, has been flat in nominal terms and probably 10-15% down in real terms when it comes to pricing. Now, we believe that supply is drastically drying up, especially in the premium housing segment. And we think that the same act which happened in offices, the same thing happened in offices, oversupply till 2009, slowdown from 9 to 12, and then a bull run from 13 to now. And we believe that's the same thing which is going to repeat, because consolidation is very strong. Sales are happening only to the top players. We've had a very decent year in sales. We're now over 4,000 crores just in the first 8 months of the year, and on track, we believe, for about 7,000 crores for the year. And we're also seeing it in some of the listed players where the stock prices are doing well and so on. So we believe that real estate is going to move up. Now, whether it's 6 months, 12 months, or 18 months, and that's to your timing question, I don't think anybody can guess, but I do think that especially if you're buying into ready property, this is a great time to buy.
So just a follow-up to that, the uptick in commercial real estate and high-quality commercial real estate was also arguably followed by a period of perceived economy boom, and in certain cases, the move to cities and people buying office space as well. The uptick in premium housing or housing of any nature would be a factor of how strongly the incomes of the residents of the country are growing. And right now, with the GDP scenario looking the way it is, do you foresee that people would have the incomes to be able to come out and buy, or would people wait and watch for that to happen?
See, clearly there has been a slowdown in GDP growth. I think nominal GDP growth this year may be about 7, 8, 9%. In real terms, maybe about 5-ish. But the fact is, it's still 8, 9%. And when we talk to foreign investors, they say, "Wow, 8, 9%. That's a whole lot." Each month for this year, we've had between 10,000 to 12,000 families visit our sites with an intent to buy, and they're spending, not 1 hour, they're spending half a day. So the desire to buy is very high, and that's driven by the fact that the overall quality of housing in the country is not great. And as people sort of make more money, they may make 7% more this year rather than a 12% salary hike, but they're still going to make more money. And in that context, people do definitely want to upgrade. Certainly all the negative sentiment, whether in the news, whether on the news channels, whether reading the newspapers, makes people worried what's going to happen. But then you still see that people cross the wall of worry, and people do go out and buy. As I mentioned, we've already done more than 4,000 crores of residential sales just in the first 8 months, and several other players in the listed space, at least their stock prices are performing well. So clearly, while there is worry, overall I think the space is headed in the right direction.
All right, so let's break it up into the commercial space and the real estate space, and even in real estate, more so about the affordable housing versus premium housing. And what's suffering is premium housing versus affordable. Do you feel that most real estate developers will now start to take a shift, or probably have a larger proportion dedicated towards commercial real estate rather than residential, or pure play residential is still going to be the big chunk of
See, there are two kinds of real estate developers. There are those who can only do housing and only know how to do housing. And in that case, they have to sort of figure out what part of the housing business do they want to play. There are the larger, more corporatized, more professional developers like us who have the ability to play across asset classes. And as a strategy, what you try to do is to figure out where is there a supply-demand mismatch in the industry and focus more of your energies towards that. So over the last 3 years, we built up a substantial office retail portfolio. We've just also done a warehousing and logistics JV with ESR, which is Asia's largest logistics player. And we're on track to have about $2.5 billion USD worth of office spaces ready over the next 2.5 years. Some of them are ready, some are getting ready this year, and some next year. So clearly, we saw the mismatch and we focused on that. Our affordable housing business is doing extremely well this year. So far, of our residential sales, almost 60% is coming from affordable housing, and the affordable housing for us is between 25 lakhs and just under 1 crore in the Mumbai region. And those sales are again doing quite strongly. Premium housing, we clearly saw and that it was oversupply, which came in up to 2015. So we haven't made any new investments or new launches in premium housing over the last 4 years. But we do see that the space in terms of supply is going to be very, very constrained starting from about a year out. And therefore, premium housing is probably the one sector which we believe will lead to a reasonable recovery in prices as the economy kind of stabilizes.
It's interesting you say recovery in prices. Have we seen prices fall all that much?
Yeah, I think I don't think there is any point in trying to fool ourselves. I think in nominal terms, you see that prices in some parts, depending on the micro market or the part of the which city it is, have been from flat to maybe 7, 8, even 10% down in nominal terms. In real terms, when you adjust for inflation, it's much sharper. So definitely there has been a meaningful correction in real terms.
And do you feel that prices are likely to move up come the next year?
See, I think we believe it's a supply-demand equation. I think there is a very significant shift which people haven't picked on yet, which is the preference to buy ready. And when you start understanding that the preference is to buy ready, then the amount of supply available is negligible. People in India have so far been used, okay, I'll buy now, 4 years you'll construct, then I'll get my house. I think that's slowly but surely going away. Ready is much better. GST is also incentivized because there's no GST on ready homes. You can see what you're buying. You can move in within a few months. You're not paying pre-EMI and rent together. So all the factors, as in all mature markets, are moving towards people buying more ready product. And when you look at the supply of ready product, it's minuscule. And I think those players who are able to deliver will benefit meaningfully from the shift in sentiment towards ready product.
Mm-hmm. Can you give us a sense of the demand, since you spoke about demand across the regions and the buckets that you might be operating in, and the inventory that you have? If I'm not wrong, the number is northwards of 40 or 1,000 crores as we speak. How do you anticipate that to get cleared looking at the demand supply equation?
No, the numbers are, I'm not sure where the 40,000 crores is coming from. Totally what we have under construction getting ready this year and next year, and unsold is just about 18,000 crores. Okay. We have an annual sales rate of about 7,000 crores. So it's about 2.5 years of supply, which is what kind of we want to be. We actually want to be around 3 years of supply unsold under construction at any point in time, because 3 years is the kind of average construction cycle, between 2 to 4, depending on the type of the product. As I mentioned to you, in Lower Parel, which is supposed probably the most focused market, all your TV channels are based here, and
it's not just because of that.
One of the reasons. And we, over the last 12 months, have sold 1,500 crores in our two iconic projects here, the Park and the World Towers, and that really shows that there is very limited ready supply, and when the supply is ready, the sales are happening. Obviously, I would say the positiveness or momentum is highest in the affordable housing category. Between 25 lakhs and 1 crores, sales are very strong, both under construction and ready. And we believe that's going to continue, purely driven by the fact that that's the market with the most vibrant demand, and the level of supply is modest.
Okay. And so how does that shape you up? I mean, let's just talk about Lodha, because we've spoken about the industry. How does this, plus with the presumption that we can't time when the recovery in pricing would happen,
nobody can.
But let's assume that the current run rate that you have, for all fair estimates, is the run rate that you enjoy for the next few months as well, or the next few quarters.
Yes.
How does that set you up for your cash flows, the repayments that you may have had across various bond or debt offerings that might be coming up for redemption as well? How do the next 12 months look like?
I think we've already clarified in relation to our USD bond, which has been the inordinate focus of rating agencies, because they only have one Indian real estate player to comment on. And as they've downgraded India They've sort of turned negative on their outlook to India, etc. They've sort of gone around and done that for all corporates that they're rating, which includes us also. So I'm not, that doesn't really do much for us. Overall, we've already clarified that for the bond, we made our arrangements. We are also in the process of issuing a new bond, which will show what confidence our current bondholders and new bondholders have in our company and its credit. Overall, what's very important to understand about our company is that against 17,000 crores of debt in India, we have 80,000 crores of assets. We are by far, when you look at the solvency ratio, which according to me is by far the better test rather than a liquidity situation, which of course there is liquidity tightness in the market. It affects us, it affects the entire economy. When you're more than 4 times solvent, you have no problem accessing refinancing. It can be slower than it used to be before, but it doesn't really change the fact that as a company, you have reasonable access to refinancing and you have reasonable access to credit. And more importantly, like I said, with 7,000 crores of sales, between about 8,000 crores of cash collections. Last year, our cash collections, which to me is the true test of the pudding, was 9,200 crores, which was 54% of the total cash collections of the top 10 listed developers in this country. We alone were more than half of the collections of the top 10 developers. So you have to look at performance. See, we're a private company. We have no listed instruments. We have no CPs. We don't borrow from MFs. So there's no information about us.
Yeah.
But because we're so big, everybody has a viewpoint and a need to speculate. I think,
It's also a factor of what happens or how you do would also be a barometer of what the large industry players might be going through, and which is why, Abhishek, the question that invariably comes in that, okay, when I ask this question, I'm in no doubt about the kind of inventory and assets that you have and whether you can service this eventually. But the question a lot of times for everybody important is that whether the cash flows and the current business scenario allows you to be able to do that comfortably when the time comes.
I think, the speculation started off, I think, in last year in December. We are sitting in December right now. Facts are before everybody. So I think, facts talk. Speculation about our company, your company, or almost any other large corporate in this country is now contagious. And it's sort of, everybody wants to speculate about everything because in general, we're a low trust society. But the fact is that performance of the top players in real estate continues to do very well. Our business is very, very diversified. We do premium, we do affordable. Our office portfolio is significant now, reaching 2.5 billion ready and under construction. So, we have retail, we have warehousing, which is probably the most diversified asset base of any real estate developer. So we feel very confident about how things are going to pan out. Clearly, we've been bringing down debt. Our debt already we paid down about 1,500 crores in the first 7 months of the year. For the whole year, we'll be paying down at least 500 million, which is about 3,500 crores, if not more. So, we are very much of the view that debt in India is mispriced in the sense real interest rates are very high. And therefore, as a company, we are focused on reducing our debt and leverage because it's not in our economic interest to be carrying debt.
Okay, so you're going to be paying down 3,500 crores of debt by the end of the year, which leaves you with a total debt across all instruments at how much?
So we'll, across all instruments, our Indian balance sheet, including the USD bond, I think that's what you're alluding to.
That's 2,300 crores, right?
Yeah. So including that, since you said all instruments, so I'll add that up. So we'll end up with about, we have at the start of the fiscal year, we had about 19,000 crores, including the bond of debt. And we'll end the year at about 17,000 crores in India, and then our UK business will also be paying down another 2,000 crores of debt.
Okay, and you also mentioned that, while obviously assets of 80,000 crores are there with you, the key question is how, when time comes, monetization of these assets is key as to how fast you can monetize these assets. In light of that, do you feel that it will come to a point where you'll actually have to bring in sell a chunk of it as a divestment, like what you did in London?
We're very comfortable internally. We are doing what we need to do. We've recently sold an office building at New Cuff Parade. We've gotten about 200 million US, about 1,400 crores as a total consideration for this. So we, as a corporate, we of course, look not just at solvency, but at liquidity, both hand in hand. Our cash flow run rate, as well as other assets that we plan to divest or diversify, or funds that we are raising. As a business, as everybody does treasury management, we do our own treasury management. But I can only be very confident about the fact that ultimately it's the operating performance of the business which dictates what's happening. And if you look at our operating performance, I think we're doing very solidly.
Okay. Let's talk a little bit more about your offshore projects and how far you've progressed out there.
So we have two projects in the UK, which we bought in early 2014. Obviously, Brexit had slowed things down. It was unexpected. At least we didn't have the ability to forecast Brexit would happen. And not only would it happen, the dates for ending it would change 4 or 5 times. Anyway, one project is complete. The second completes next quarter. Sales have been very strong. In fact, just in the last month, we've had sales at record prices, 6,300 pounds a square feet for one unit, 6,700 pounds a square feet for another unit. Yes, at Grosvenor Square. Lincoln Square, as I mentioned, is already complete. We've paid down most of our senior debt, and the rest will get paid down over the next 45 days. So we are, of course, at a point where those two projects have gone through a long cycle driven by the uncertainty caused by our learning curve as well as Brexit, but now in a good space.
And you were due to receive some monies for the same. I'm just reaffirming this. You've received those monies against the inventory sold. I think, unless I'm very wrong, about 490 odd millions.
Now our sales are up to 600 million.
Okay, and the monies are coming in steady as she was. Okay, great. The other bit is, since you mentioned operating performance, just a couple of accounting questions, if you will, and if you can speak about them. I think we figured out, at least just looking at the numbers, that the move to the Ind AS 115 helped the sales numbers and the bottom line numbers as well for the year gone by. Save for that, it may not have been necessarily as strong. I'm not saying you've done some jugglery. I'm just saying the move to an accounting standard has helped that. Also, your cash flows all through the years have been robust. There has been, maybe due to economic conditions, a bit of a change in the cash flow situation as well. Do you reckon that will change?
No, as I mentioned earlier in this interview, our cash flows last year were our strongest ever. 9,200 crores of cash collections in India, in addition to whatever we've collected in UK. As I mentioned, 54% of the total collections of the top 10 developers was just our collections.
Sure.
So we had a very strong year last year. Yes.
Okay, and the move, this accounting standards, because if I'm not wrong, Abhishek, and please correct me if I'm wrong, if we don't consider the Ind AS impact on the profits and revenues, then there would have been a flatline move and not necessarily a bump up. Is that a correct assessment?
I haven't done the Ind AS versus non-Ind AS because it was compulsory for all real estate players as on 31st March to move to Ind AS. So we've done that. I'm happy to get our CFO to look at that and answer that question for you.
Fair call. Just a follow-up on to what do you think happens to the space over the course of the next 12 months? The reason I ask this is because typically in any industry that we're seeing, the top 3 or 4 or top 5 players are now weaning away business from the smaller players. Do you reckon something like this could happen in real estate? The only reason being, hitherto it's been that very effective owning the land and operating well in that area, and those builders also survive and do very, very well. There's a bit of a trust factor associated with even the smaller names. Do you think that changes over the course of the next 24 months?
No, I think you've hit the nail on the head. It's all about credibility and delivery. It's not about the size of the player. There are big players who are credible and will do very well. There are big players who have not delivered or are not delivering, and they will not do so well. And equally, the local small players who are credible, who make sure they deliver on their promises, and they'll do well. So I think it's all about credibility. But if Mumbai has 2,000 active real estate developers 2 years ago, the number of those who are credible, who deliver on time, 4 out of 5 units we deliver are before time. So those who deliver on time is probably 10% of that. And it's those 10%, big or small, I'm not talking about big or small, it's those 10% who will survive. And it is rightly so survival of the fittest. But I would take a bigger picture that overall real estate's contribution to employment creation and real estate's contribution to creating of wealth for the country and especially for the middle class is extremely important for any economy. And therefore, for Indian economy to do well, for consumption to keep growing, for our employment to keep going up, real estate is extremely important. There is no other country in the world which has grown from being a low-income country to a mid-income country without real estate being at the forefront of that growth. I mean, China is, of course, the best example, but there are many others. And therefore, I think overall, whether it's policymakers, whether it's media, we need to realize that while real estate is something we all have a view on, the overall impact of real estate doing well and its overall positivity to the whole economy is something we all need to take into consideration as we formulate our various views on the industry.
No, of course, it is almost like we talk about consumption being the backbone of growth. Housing as a pocket is very important. I also wanted to actually ask you about whether or not you had any sort of a negative impact by the Moody's downgrade that happened in terms of fund sourcing, in terms of...
No.
No negative
It's like I said, that bond rating is on the USD bond. We've already explained to them that the bond is fully organized for. They tell us, A, we are downgrading India. B, we need the 325 million in the bank. The bond is due 4 months out. At least I'm a bania. I don't keep 325 million in the bank to pay off 4 months later. So fine, let them downgrade, let them do what they want to do. We've stopped caring about it.
But liquidity, if you were to talk about it for yourself, is not an issue at all.
No, liquidity in the market is certainly an issue. So
Okay.
it continues to be an issue for everybody in the marketplace. If you look at credit growth or credit availability to commercial, non-agri, it was down, 90% or something, 88% in the first half of the year. So clearly it's a matter of concern. But we are able to manage it. That's the point.
All right, so fundraising activity?
Yeah, I said we're just completing the sale of one office building. We are in talks for a couple of other equity transactions at the project level. So we'll continue doing that. We've always done that. 1 or 2 transactions a year we keep doing, we'll keep doing.
Cost of funding on the debt side, is that, so for a player as large as you, one is the asset sales and you raising money that way. 2 is the money raised through debt.
Yeah.
Is that becoming an issue at all, Abhishek? Not just
The
for you.
cost of money?
Yeah.
Yes.
No. Cost of money is
No?
not. Our average cost of borrowing is about 12.4%. It's been at that level for the last 2.5 years.
Wow. Okay. Would you
even
believe?
this entire period of slowdown that we've seen has not changed at all?
15, 20
Margin.
bips, it's
Yeah.
gone up, but I don't really see that as something meaningful.
Okay. One final
Hopefully
question.
RBI's rate cuts will eventually reach out to the rest of the financial sector and we'll see some downward movement.
Yeah, well,
Which is
the governor was
actually
hopeful for that.
Yeah, which is another thing that we could probably get your view on is the steps that the government has been taking for the industry as a whole in terms of clearing that inventory, stalled projects that will come on stream again and add to the inventory that's already there. in the system.
I think the government's taken a fabulous step with this stressed asset fund. We will get no benefit because I don't have any stalled projects, but I think for a nation, it's absolutely important when people put in their trust, buy a home, and they see this thing half built and then running around pillar to post. It destroys trust, and it's a waste of national wealth because everything that's in there is wasted. Nobody can live there, nobody can do anything with it. So this money coming in, those projects getting completed, people getting their homes, I think is absolutely wonderful idea. I'm sure I read, I think over the weekend or on Friday, that the first close of the fund, the stress asset fund has now closed. They've closed at 10,000 crores. It's a big sum of money, and I think that peak is about 400 crores a project, and I'm sure the average will be lesser than that. So there's a large number of projects which will benefit from this. So I think over the next 12 months, it will both lead to employment generation and, more importantly, rebuilding of trust for those who've had their life savings stuck in these projects.
Okay. My final question, Abhishek. Do you reckon that, would that be a change in the way developers do business as well? And I ask this question to you because there's a lot of talk about the erstwhile or maybe even the continuing model of owning land and building it over a period of time versus doing JVs with landowners or established players, not necessarily having to own land, but using the brand name in order to earn a higher ROIC development. What do you think a large player like you would do? The easy answer might be a mix of both.
I
but
think
still.
real estate is a cyclical business, especially the housing part of real estate is a cyclical business. And so in the midst of any cycle, to believe what's going to happen when the cycle turns is very difficult to understand. Yes, today, certainly, when landowners have difficulty in monetizing their asset, they are more amenable to joint ventures. So we receive, a proposal a day. And that's something definitely doing because it helps improve, theoretically should help improve ROCE. Whether it helps improve ROI, I don't know. But as you move to other parts of the cycle, you may have different trends coming into play. So overall, we think that you have to be nimble. You have to have your own land. You have to do joint ventures. You have to make sure that your capital is sensibly allocated.
Just one final question, since we're talking about the RBI and the government. No rate cut this time from the RBI, but transmission has been slower. Do you see, especially for home owners and home buyers who are going in there, bank financing is a challenge to get in at
No, I think mortgage availability is very robust in our country. Okay. I think mortgage availability is at about 8%, which I think is too high, given that, in my view, we have virtually no inflation, or if no core inflation, take out food and fuel, there's virtually no inflation in the country. So 8% is too high, and I hope that with all these linkages to the repo rate and all of those things, over time mortgage rates will come down or should come down in the interest of the economy and demand creation. Having said that, mortgage availability is very robust. I think leaving aside my real estate hat and wearing more my macro hat, where I think India will have to take a view on is that when demand is as tepid as it is right now in certain parts of the economy and sentiment is negative, we need a bazooka to come out and change sentiment, because otherwise, we can keep calling ourselves bad and we will really truly become bad. We are not bad right now. So, what is the bazooka? Does India need its own form of quantitative easing? I think, whether rate cuts will transmit or not is a question of how much liquidity ultimately is in the system. We have a lot of liquidity, but I think it's trapped liquidity in the banking system, with the banking system unwilling to let that liquidity out into the real economy. So I think we need to break that log jam, and I'm sure the governor and other experts will think about it seriously.
Well, let's hope so. Anyways, Abhishek, great having you. Thanks so much for taking the time out and being with us. And viewers, thanks for tuning in to this leg of BQ Conversations.